Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. You know, if you believe in the future of electric vehicles and the greening of the world and all the money that's going to that, but like me are frustrated trying to find anything that you can invest in that's reasonably valued at this point, then this video is really for you. Because I'm going to show you today a Dividend Challenger, a company that's actually increased their dividend for 11 straight years, has a good current yield. It's an A+ rated company. It's attractively valued, and it's literally poised to even potentially give Tesla a run for their money in the electric vehicle industry. So this is one you really don't want to miss. But let me put this into perspective for you by going into FastGraphs here. And I'm going to start by using the new version of FastGraphs, because I want to just go through some stocks quickly, but I'm going to spend most of my time in the current version. You know, obviously, when you think about electronic vehicles, you think about Tesla, but here's the problem. Tesla's actually lost money. I'm using operating earnings here. Tesla's actually lost money up until 2019. Now, they're starting to earn some pretty decent money in 2020. They earned over $2.24 a share, and even as much as $5 a share in 2021. So the company's earnings growth is starting to accelerate. But if I look at that from a standpoint of forecast growth, which is expected to be over 25% a year, 27% precisely, then if I applied a normal, 25 to 30 multiple to this stock, it would be a losing money situation for at least the next several years. Now, there are other stocks like Plug Power, which is in the electrical components and equipment, another, greening of America or a greening of the world type company. It's lost money, substantially. It looks like it's getting ready to turn a profit in the next 2 or 3 years, but it's extremely overvalued, and you can see that the price has fallen, dramatically just this year. Another example here I want you to see is Nikola, and this is, by the way, named after, Nikola Tesla was the brilliant genius that basically was the namesake for Tesla. This is the first name, Nikola. And Nikola builds hydrogen-based trucks, but again, you can see that they've lost money, and this stock has been under a lot of controversy later. And again, we've had very, very poor performance, but there's nothing really investable here at this point. That's the point I want to make. And then another, famous electric vehicle manufacturer, if you will, would be Nio. And Nio is very, very similar to what the situation that Tesla's in, just starting to make money, but everything's in the future, and you're paying a very, very high valuation to invest in the company. And it doesn't even have anything like a PE ratio, because obviously the company's losing money right now. So the reality of it is even though this may be the future, and analysts are expecting great earnings out of these, companies in the future, Nio, Tesla, etc., the problem is there's very little to buy now. Now, as a value investor, I keep a running list. Now, people ask me if I would give them this list, and I'm going to tell you right now, the answer is no, because I'm constantly evaluating this list and I'm constantly trading this list. I call it my core income buys list. Okay, these are companies that have earnings yields above 6.5% to 7% and PE ratios that translates into about under 15%. And these are income producing stocks. Now, the problem is all those stocks I showed you in the electric vehicle industry, if you will, as well as the green energy, area like Plug. The problem with those, none of them pay dividends, and they're years and years away from paying dividends, and they're all very, very expensive. So what I'm going to do is I'm going to show you a company that's a very high quality company, Cummins Inc., which is known for their diesel engines. So let's start by looking at the stock from a fast graph point of view. Let's look at their earnings per share. Earnings per share, these are operating earnings, adjusted operating earnings. And Cummins, by the way, is a dividend challenger. They've increased their dividend for 11 consecutive years, and they've done it at a very attractive rate. Now, I'm going to call out some really crazy numbers here. It's been a 20%, dividend grower. The last couple years, it's been in the 5%, 10%, 7% growth last year, but it's had a very great history of earnings growth, but it's cyclical, and therefore their dividend growth is also cyclical. So I want you to be aware of that. They go from, not growing their dividend a whole lot in one year to growing it by a huge amount in the next year. And that's very similar to their earnings here. Okay, now the other thing I want you to see, now this is the earnings per share. The growth rate's been about 12% a year. That's very, very attractive for this time frame. If I look at the all-time frame here, the earnings growth rate has been about 15% a year. So even though there's cyclicality here, you're going to get different growth rates when you change time frames. You know, I run it to 2008, I get 11%. I run it from 2012 and I get 7%. It's because it really depends on what part of the cycle you're hitting and when those cycles go. But generally speaking, this is a very renowned company. It's A+ rated, only has 32% debt to capital. And really, it's a growth stock from a standpoint of earnings growth, but it's also a growth stock from a standpoint of dividend growth. Now, I want to put the monthly closing stock prices on the graph so that you clearly see that this stock price, even though this is a cyclical company, the stock price has tracked the company's earnings growth almost perfectly. And, you know, here we've got a beginning PE of 14 and an ending PE of just over 15, which tells me that if I look at the performance of this stock over this time frame, it's going to be real close to this, the capital gain now only, not the income, but the capital gain only will be close to this 15.57%, growth rate that the company achieved. So let's go ahead and look at performance, and we see that capital appreciation, growth, if you will, has averaged 16.8%. Now, just to be clear, because I want you to understand how that happened, that's a function of a little bit of PE ratio expansion, the PE going from 14.3 to the current blended PE of 15.7, which, add up the 15.57% growth rate and you get the higher 16.8% capital growth. The key of value investing, and I say this often, but I can't say it often enough, is that when you invest in a stock at value, you position yourself to participate fully in the operating results of the company. And here we have a classic example of that I can really measure at real close to even, being slightly undervalued here to maybe just a tad overvalued here, 15 PE. Earnings yield of 6.67 would be what I'm looking for. We currently have an earnings yield of 6.36. So it's a reasonably valued stock. It's fully valued, but reasonably valued stock relative to anything else I showed you that's participating in the, greening of America or the EV market. Now, I do want to go to the Wall Street Journal real quick here before I move on, go into the company's board. Barron's did an article last week called Cummins Can Give Tesla a Run for Its Money as an Electric Vehicle Company. See, you don't think of Cummins, you think of it as a diesel manufacturer. But I'm going to try to alter that view of the company a little bit because, as Barron said, I agree. This company is investing heavily in the future greening of America, not just electric vehicles, which they're working on very strongly, but also hydrogen and even natural gas, which gives a lot less emissions than a diesel engine does, for example. So, they're aware of the greening of America and they're moving in that direction. The company was talked about in a recent article, in a press release rather, that they did, where they pointed out that they're moving heavy-duty trucking down the path to zero emissions. And I'll get into that a little bit more, but I'm going to leave most of that kind of research to yourself. So the point is, this is a company that's participating in the greening of America. And I'm on their website now here, and what you see here is a commitment, if you will, from the company that they're innovating to reduce emissions, okay? And then you can click on here and go to their vision there. I'll let you do that yourself. But they're also evolving for a greener America. And I want you to be aware of that because I want you to not think of them as a diesel company here, but think of them as a green company, okay? Helping to build a green economy, okay? They're heavily involved in hydrogen production, which hydrogen vehicles is what Nikola that I mentioned earlier is talking about. Okay, and what they're doing is their high balance in Denmark is supplying clean hydrogen to 1,000 fuel cell vehicles. That's not electric vehicles, but that's obviously, very green vehicles. And then they're enabling utilities to store excess energy. Now you can go through here and get into the company's website, and you'll see that there's, a whole lot, including reading the article about, giving Tesla a run for its money. You might have to be a subscriber to be able to do that, though. But I do want to point out that this is a good growth stock. Their diesel engines are, considered the best of the breed. They're still making those, but they're moving to all these other areas of the greening of America, and it's a dividend challenger. The company's increased their dividend for 11 consecutive years. Now, I want to focus on that for a moment. If I look at this white line, this is their dividends per share. I do want you to note that it's significantly more consistent than the earnings line or the price line. Okay, and that's not untypical for a company. Also, I want you to notice that a 15-ish PE ratio has been pretty much the norm. I'm showing a 15.57, which is P equals growth rate on this particular iteration or time frame that I'm showing, and then the normal PE has been 15.3. So we'll just call it a 15 times earnings company historically, with a very, very consistent dividend record. Then the dividend has grown very fast. The stock is currently yielding 2.43%, which is above market, but it's the growth yield. When you look at the fact, if I go back to 2001 when it was a little cheaper, it had a 3.2% yield. But that yield, now they started raising their dividend in 2006. I want you to notice that. So the yield increased to almost 55% yield on cost, or what I call growth yield. So if you're looking for dividend growth, this is a really terrific company. Now, I will tell you, I would like to see the stock a little bit cheaper. But, the main thing I'm focused on here is that you could participate in this, future of electronic vehicles, hydrogen fuel cells, the greening of America that this company is so committed to. And you can do it by getting a very generous dividend and a very good performing stock. I might add, total performance has outperformed the market dramatically over the long run here. Okay. And you can go through different performance records when you look at Cummins yourself. If you're a FastGraph subscriber, for example, you have that ability. And it's another reason why any of you who aren't FastGraph subscribers might want to take on our freemium version right now, where you can test drive about 10 or so different stocks in different categories and see how much FastGraphs can benefit you as an investor. But I want to move on now, since I'm so focused on dividends. Cash flow, operating cash flow is where the dividends come from. I want you to notice that the company has very strong operating cash flow growth over the long run here, over 10%, and the operating cash flow, notice the coverage of the dividend. Forget about the price. Now, the valuation metric here is not one that I think is, completely irrelevant. Obviously, this company normally trades at around a 10 times cash flow number. When I change this, you'll see that it changes. 10, 11 times operating cash flow is about normal for this company. But what I really want you to see here, forget about the price equation. I want you to see here that this company is covering their dividend with operating cash flow. But the real acid test that I always like to point out is to look at the company from a perspective of free cash flow. And when I look at Cummins from a free cash flow perspective, I see that free cash flow covers the dividend very well also. And remember, this is an A-plus rated company with only 32% debt to capital. I consider that very attractive. The company has an extremely strong balance sheet. So if I go through, different metrics here, here's price to EBITDA. The stock looks reasonably priced. The other thing I like is the stock has been reasonably priced through all these time frames that I've been showing you, and the company has been buying back shares. These are common shares outstanding. They've been averaging since the Great Recession. They've been buying back about 2% of their shares per year. They've reduced the share count from 200 million shares down to 149 million. And as an investor, that means that I'm getting every share that I own is giving me a little higher percentage. And it's also supporting the earnings growth and the cash flow per share numbers that I've been showing you here, on the thing. Again, going back to the Teslas of the world, they're very, very expensive. Obviously, everyone's gotten excited about this, but you really can't participate this in a prudent way, in my opinion. Instead, I can go look at something like Cummins here, which is participating in all this green stuff that we talked about. And I have something that's very, very attractively priced. Now, I might want to get a little cheaper if I'm really looking for a margin of safety, because if I go back to Cummins here as an operating earnings company, I do want you to note that, it does dip down below operating earnings growth several times when it hits a down cycle. The problem is we're really hitting an up cycle right now. And there are reasons for that. And a lot of it has to do with the greening that I've been talking about here, so much in this particular video. And I went and I subscribed to Zacks Investment Research, and I did a research, I did some research on Zacks. Zacks expects their revenues to grow dramatically. They're looking at gross sales of about $19 billion in 2020, growing to $24 billion in 2021, then growing to $26 billion for 2022. So we're looking at gross revenues to grow dramatically. And the sources of that are kind of interesting. Now, Cummins engine segment represents 32% of their consolidated net sales in 2020. These are all going to be 2020 numbers that I'm sharing with you here. This is from Zacks. Okay, that's where they produce diesel and natural gas-based engines for on-highway and industrial markets. So that's still their biggest division today. They also have a distribution segment, which is 29% of their sales. It operates through a worldwide network of wholly owned joint venture and independent distribution locations that offer a varied range of products and services, including power generation systems, high horsepower engines for heavy duty construction, which, by the way, would also represent a play on the infrastructure build out that's expected coming up here. And then, high horsepower engines, heavy duty and medium duty engines. They also have a component segment, which represents 24% of their sales. They have 5 businesses there: emission solutions, turbo technologies, filtration, electronics and fuel systems, and automated transmissions. The systems offered by this unit, according to Zacks, support the engine and power system segments of Cummins, including after-treatment systems, turbochargers, filtration products, etc. But the interesting segment, which right now only represents 15% of their sales, is the power segment system. And here they sell power generators, diesel and natural gas, high horsepower engines, AC generator or alternator products for internal consumption, and external generator set. It's organized into power generation, industrial and general technology product lines. But it also, this new power segment manufactures, sells, and supports hydrogen production systems, as well as electrified power systems, ranging from fully electric to hybrid vehicles, along with innovative components and systems. So it's the smallest segment of their business, but it probably has one of the most exciting components for growth. So, I hope you've enjoyed this video. If you did, give me a thumbs up. Subscribe to the channel if you haven't already, ring the bell. But this is a good dividend growth selection that I think is reasonably priced today. If you prefer, you might want to hopefully see if you can get a little cheaper by waiting a little bit. But I really like this stock. I like the quality of the company. I like the fact that even though they're a well-established, diesel engine manufacturer, considered the premier one in the world, the company is aware of how the industry is changing, and they're at the forefront of those changes. They may actually turn out to be a leader in that. So possibly Barron's is right. Cummins could give Tesla and other electric vehicle manufacturers a real run for the money in the future. But the best part is it's reasonably priced. It pays a great dividend. And I think it's an extremely high and very safe quality company with a very safe dividend. So it's something you might want to take a closer look at. Thanks for watching, and look forward to talking to you guys again real soon.